Hello students, welcome to EPG Pathshala. I am Dr. Sanjay Rastogi from Indus Business Academy, Greater Noida. The module which we are going to discuss today is Double Entry System and Recording of Transactions in the Books of Journal under the paper Accounting and Financial Analysis. What we are going to discuss in this module today is what is Double Entry System and how we use double entry system while we record the business transaction in the books of journal. As we have discussed in the previous module, Principles of Accounting, we have seen that double entry system is one of the basic concepts of accounting, and that is also the backbone of entire accounting system. We use double entry system to record the business transactions right from as and when it takes place in the business, and we prepare and present the financial information of the company. What we are going to learn out of this module today is what you will be able to understand by the end of this session. You will understand the conceptual framework of double entry system, where you will learn the various types of the accounts, real, personal and nominal. You will understand that how we record the business the transaction in the books of journal by using the rules of double entry system, that is debit and credit. You will also learn that how you apply the rules of debit and credit while you record the business transaction in the books of journal. Now let us understand the double entry system. What is this system all about? The double entry system is based on the principle of dual aspect, which used while recording of various business transactions into books of accounts. According to the duality concept, as we have discussed under the principles of accounts, that assets are always equal to the liabilities at any point of time. Thus, in double entry system, every business transaction has twofold effects by affecting at least two accounts in opposite directions. The effect of a transaction will be positive or negative on business at the same time. The effect is positive when the asset of business increases or liability decreases. The effect is negative when asset decreases or liability increases. The positive and negative effect of a transaction on assets and or liability are shown by two symbols. The symbol one is debit, another symbol is credit. For any transaction, one account is to be debited and another account is to be credited. Debit and credit of accounts are dependent on the nature of accounts. On the basis of nature, the business transactions are classified into two categories: personal accounts and impersonal accounts. Personal accounts are recategorized again under three categories: natural personal accounts, artificial personal accounts, and representative personal accounts. Impersonal accounts are again recategorized into two: real accounts and nominal accounts. Real account is again recategorized into two: tangible real account and intangible real accounts. As we have categorized the business transactions for the sake of recording in the two categories, one is personal accounts, another is impersonal account, let us have a discussion in detail on the personal accounts. All transactions are categorized as a personal account which deals with any individual or any organization or any company. The individuals like Ram, Mohan, or any other individual, the living being. Any transaction which takes place with the Ram, as I said, the Ram, Mohan, that falls under the category of the natural personal account. The transaction which takes place with any company, for example, Reliance Telecommunication, the Tata Services, These transactions falls under the category of the artificial personal account. They are not the real personal account. I mean, they are not the natural personal account, but they are treated as a personal account. The third category is the representative personal account that we will discuss later on. So, any transaction which happens with any organization, say the bank or any college, that also comes under the category of personal account. The investment of owner in the business does comes under the personal account. I mean, that is the capital account, which is also the part of the personal account. The capital which is being invested by the owner comes under the personal account. Personal accounts are reclassified again into three categories: natural personal account, artificial personal account, and representative personal accounts. Personal accounts are recategorized into three categories: natural personal account, artificial personal accounts, and representative personal accounts. Let us discuss on these three categories of personal accounts. Natural personal account. A natural person means accounts of individual person or human beings. As above we have seen, accounts of individuals like Ram, Mohan, Atul. Owner's capital account are also termed as a natural personal account. Artificial personal accounts, the accounts other than the accounts of individual or the human beings, are known as the artificial personal accounts. As we have already discussed about the accounts of institutions, firms, companies are termed as artificial personal accounts. Representative personal accounts, sometimes some impersonal accounts are treated as personal accounts. Though these accounts are not classified as a impersonal and not as a personal, but due to change in the circumstances, they are treated as a personal account for a short span of time. After its settlement, they will again be treated as an impersonal account. Due to this character, treatment of impersonal as a personal for a short span of time, these accounts are termed as representative personal accounts. The another category of business transaction is impersonal account. Impersonal accounts are those accounts which are not the personal account, and the impersonal accounts are again recategorized into two: real account and nominal account. Real accounts are related with all the transactions related with the purchase and sale of goods and the assets of the business. It is again recategorized into two: tangible real account and intangible real account. The second the category of accounts under impersonal account is nominal account. Nominal account deals with receipt and payment of the business. It deals with the profits, recording of the profits and the gains of the business, as well as the loss of the business. Impersonal accounts are categorized into two: real accounts and nominal accounts. Real account, any transaction which is related with the assets or property of business or the expenses of capital nature, as we have already discussed in our previous module, is recognized as real account, such as building account, furniture account, cash account, bank account, goods account, goodwill account. Real account is also categorized as tangible real account and intangible real account. What is tangible real account? The accounts or the assets which can be seen and touched, like building, furniture, cash, goods, purchases and sales, they are categorized as the tangible real account. Intangible real accounts are those assets which we cannot see, we cannot touch, but we can feel the existence of those assets. For example, goodwill, copyright, patent, these are categorized as the intangible real account. The nominal accounts, all expenditures and incomes which are of revenue nature, and we have already discussed about the revenue and capital nature of expenses already in the previous modules. Any gains or losses are termed as a nominal accounts. For example, the salary, wages, rent, These are the examples of the expenditures. The bad debts is the example of the loss. If the company or the firm receive some amount in form of commission, discount, they are the examples of the income for the company. So all these types of accounts are categorized as the nominal account. Now, having discussed the various categories of accounts on the basis of the nature, let us discuss the rules of debit and credit of these various accounts. For personal account, the golden rule of accounting is debit the receiver and credit the giver. Any person who is receiving the items or something from the business is to be debited, and the person who is giving something to the business, or in the case when business is receiving something from someone, is to be credited. For real accounts, the rules of accounting is debit what comes in and credit what goes out. So you have to debit the things which are coming into the business, and you have to credit the things which are going out of the business. For nominal accounts, the rule of debit and credit is debit all expenses and losses and credit all gains and profits. Any payment, for example rent, salary, the losses like bad debts, is to be debited, and any gains or the profit like any receipt of the commission or the receipt of rent for the business, they are to be credited under the nominal accounts. After understanding the golden rules of accounting for debiting and crediting the various transactions of the business transaction in the books of accounts, now we will see that how transactions are recorded in the books of journal. To record the transactions in the books of journal, we have to follow a process. That process has 4 steps, that we have to identify that what to record, when to record, where to record, and the 4th step into this process is how to record. So since we have discussed that each and every transaction of a business cannot be recorded in the books, so we have to identify that what are the items or what are the transactions which can be recorded, that is to be identified. Then the second step would be when to record. It should be recorded at the time when it is taking place, or we can postpone it until it is received in cash or paid in cash. The third step under this process is where to record. As we have seen that there are the various books of accounts to record the transaction, but here we will discuss that how to record the transaction in the books of journal. And the 4th step would be how to record, and that we have seen that we will be recording the transactions in the books of journal using the concepts of double entry system, and for which we have already discussed the golden rules of accounting. Now let us discuss that how we record the business transaction in the books of journal. To record the business transaction in the books of journal, we normally follow some steps. These steps are what to record, when to record, where to record, and how to record. What to record under these steps, all the transactions which takes place in the business should not be recorded. The transactions which can be expressed in the monetary terms, in the Indian currency or the currency of any other country, that can only be recorded into the books of accounts or the journal. The second step is when to record. We can record the transaction in the business on 2 bases, accrual basis or the cash basis. Under cash basis, we record the transaction as and when the cash is realized from the transaction. When we realize cash from the transaction, then it would be recorded. Under the accrual basis of accounting system, we record the transaction in the books of account as and when it takes place. We do not wait for the cash to come to the business or cash to be disposed to the business, because sometimes the transaction may be on the credit basis that may take some time to settle. So we cannot wait by the time to settle the accounts. So in accounting, we follow the accrual basis of accounting and we record the transaction as and when it takes place. Where to record? Now we have to identify the transaction is to be recorded at which place. For this, we have various books of accounts. we can record the transaction in journal, which is the very first step and the original books of accounting, or we can directly record the transaction in the subsidiary books as well. But here we are recording the transaction in the journal. The fourth step under recording is how to record. We have already discussed that the transactions are recorded with the help of double entry system, under which we identify the various types of accounts under a transaction, and then we apply the rules of debit and credit, and then we record the transaction in the books of. Now let us discuss on the element of a journal book. As we have already discussed that the transactions which we are recording is in the journal book. So the journal book is the original book of account where we record the transactions of the business very first time. So if we look at the format of the journal book, we find that there are few columns. The extreme left column starts with the date. Date is the column of the journal book in which we record the transaction at the date of occurrence of a transaction. In this column, we record the year and the month of the transaction as well. The second column of this book is the particular. In this column, the transaction is described and it is mentioned which account is debited and which one is credited. The account which is debited is recorded first and which is credited recorded next to it. To show a debit account, we use the symbol debit, that is called as a DR, at the end of the account name, and to show the credit of account, we use the symbol CR, that is the short form of the credit. At the end of account name, we use 2 before the account name, because in case of the credit, we do not use the word credit. After debiting and crediting both the accounts related the transaction, we precise the transaction. This is known as the narration. Narration is a transaction help to know the reason why this entry has been passed. The next column after the particular is LF, that is called as a ledger folio. Ledger folio means the page number of the ledger. As we know that after recording the transaction in journal, these transactions are classified and posted to the ledger. When any entry from journal is posted to the ledger, the number of that page of ledger on which this particular entry has been posted is mentioned in this column. Ledger folio saves a lot of time to verify an entry in case of discrepancies, as direct that page of the ledger will be searched to verify. In the absence of ledger folio, all pages of the ledger need to be searched, which will be mere wastage of time. The next column in the journal book is amount, and the amount, we have 2 amounts of the column, amount debit and amount credit. In debit amount column, we will be mentioning the amount that is to be debited, and in credit column of amount, we will be mentioning the amount that is to be credited. And you should note that in the case of the amount, both debit and credit column would be debited and credited by the same amount. The final, when we close the page, we go for the totaling of the debit and credit, and the journal book is total at the end of the particular period, and at the end of every month it is necessary that total of the both column, that is the amount debit and credit, must be equal. Then only it would be justified that the double entry system has been correctly followed. This is the journal page, how it looks like. As we have already discussed, it starts with the date, then particular, then ledger folio, then amount debit and amount credit, and at the end of the page it should be total, and both the column total should be equal. Now, since we have already discussed about the double entry system, and we have seen that under double entry system, in a transaction, at least 2 accounts are affected, and those 2 accounts are debited and credited at the same time. And we have also seen and discussed that the debit must be equal to the credit. It means at the same time, debit should be equal to the credit. Now we would see that how we identify the accounts from the business transaction which is to be debited and credited at the same time. In order to identify the debit account and the credit account in a transaction, we have 3 steps which is to be followed. Under first step, we try to analyze to identify that what are the 2 accounts which are affected under a business transaction. The 2 accounts which may be from the various accounts which we have already discussed, it may be from the real, it may be from the personal, it may be from the nominal, or it may be from the combination of accounts as well. It may be from the combination like real and personal, real and nominal, or any other combination. So under second step we have to identify that what are these 2 accounts are affected. It is, and those are related with the real, personal, or nominal, or with the combination. Under the third step, once we have already identified that these are the 2 accounts which are affected by the business transaction, then we apply the rules of that account that we have already discussed under the golden rules of accounting, debit and credit, that has already been done. Now we will learn the recording of transaction in the books of journal with the help of accounting. Whatever the steps we have discussed right now, we will implement and we will learn with the help of an example. Now let us understand with the help of an example that how the transactions are recorded in the books of journal. This is, as per the illustration, we can see this is the various transactions of Mr. Manohar for the month of January 2013, and we have to journalize these transactions in the books of journal. So what are the transactions? Let's have a look first, then we will see that how these transactions are recorded. The transaction first happens on the January 1, that the month is January and the date is 1, the 1st January. A business was started with the cash of rupees 1 lakh. Then on 2nd January, he bought some goods for cash 20,000. The third transaction is he bought the goods from Kamlesh for rupees 30,000. On 4th of January, he bought some furniture for the business for rupees 10,000. On 5th of January, he sold some goods to Mr. Shyamlal and Sons for rupees 25,000. On January 6th, he sold some goods for cash rupees 15,000. On January 10th, the goods worth 2,000 was withdrawn for the personal use. The salary was paid rupees 3,000 on 21st of the January. On 30th of the January, the rent was paid rupees 1,000, and on 31st January, a cash paid to the Kamesh was rupees 10,000. So these are the transactions which we will see in the coming slides that they are recorded in the journal books. Now let us journalize these transactions in the books of Manohar. So what was the first transaction? The first transaction was business started with cash rupees 1 lakh. If you can recall that before we journalize the transaction in journal, we follow the 3 steps. What was the first step? We have to identify the 2 accounts which are associated with the transaction. Then we have to apply the golden rules of the accounting. So in this transaction, one account which we can identify very easily, that is the cash. But another account is not clear. We can identify the another account by looking that the above cash is bought into the business by owner, and the owner investment is always treated as a capital. Since we have discussed under the concepts of accounting, the business is treated distinct from the owner, applying the separate entity concept. Hence, the amount invested by the owner is a liability for the business, because owner is now treated as outside person and whom business has taken fund. Thus, the amount invested by the owner is here referred as capital. Now, the second account is identified, that is the capital. So what are the 2 accounts which we have identified? One is cash, another is capital. Now the second step is we have to identify that with which nature these accounts are related. So we can easily identify that the cash belongs to the real category and the capital belongs to the personal category that we have already discussed under the concept of double entry system. Now, we will apply the rules of these accounts for real and the personal category. For real, we know what are the rules: debit what comes in and credit what goes out. Here, the cash is given by the owner. It means the cash comes to the business. Business is receiving the cash. Hence, as per the rule, cash is coming to the business, which is to be debited. And for personal account, we know what is the rule. The rule is debit the receiver and credit the giver. So, as the owner has given cash to the business, thus the owner is giving cash to the business, so owner is giver. It means we have to credit the owner. So as per the rule, we have to credit the capital. So now we have identified the two accounts. We have also identified that with which category these two accounts belongs, which is real and personal. And then we have also identified that what rules will be applied on it. So if we look in the nutshell, the journal would be like cash account to be debited and capital account is to be credited. As we have already discussed that the debit is to be shown or denoted with the initials like DR, but for credit we do not use the initials of CR, we use 2. So if you look at the journal book, how we have recorded? First we have recorded the date, which was the January 1 and the year was 2013, and then the accounts which we have identified would be recorded under the particular. What is the accounts which we have identified? Debit and credit. What is debit? Cash is debited. Always the debit comes first and then we go for the credit. So cash account ... debit to capital account. To here means the credit. The cash account debit and the capital account is credited. And now look at the amount column. Amount column, what was the amount? 1 lakh rupee. For debit, it is 1 lakh rupee, and for credit, it is again 1 lakh rupee. Hence, the both debit and credit are equal within one transaction. Finally, we will go for the narration. What is the narration? Narration, as we have already discussed, that is the mirror of the transaction. Why this transaction has been passed? So the narration would be like, we start the narration with in the third form, it starts either with the being or the another word is for. So here we have used the word being. Being, business started with cash. So it means when a layman look at this transaction for the debit and credit, he or she can easily identify why this transaction has been passed. So this transaction has been passed just because the business is started with the cash of rupees 1 lakh. Now, what was the second transaction? The second transaction was bought goods for rupees 20,000. The same rule we will follow. We would identify the 3 steps and then we will pass the journal into the journal book. So in the second transaction, we have to identify the 2 accounts. What are the 2 accounts? One is goods, another is the cash, right? Because business has bought some goods. First account is good and the another account is cash. Goods are related with the real category and the cash is related with the real category again. So both the accounts are related with the same category, that is the real. Here we have 2 accounts from the same group, right? As per the rule of the real account, what is the rule? Debit what comes in and credit what goes out. Here, as goods are bought, it means it has come into the business and it is to be debited. Now the cash is going out of the business. So since cash is being disposed from the business, it is to be credited. One thing here is important to understand, that the goods account are again recategorized into 2, purchase and sales. When we buy the goods for the business, we use the word purchase, and when we sell the goods, then we use the term sales account. So here we have now identified the 2 accounts. One is the goods and the cash. We have also identified which category they are related. They are related with the real category, and now we have applied the rules. As per the rules, we find debit what comes in and credit what goes out. So when we apply the debit and credit and we record in the journal, we find the purchases account debit and cash account is to be credit. So how we would write this transaction in the journal? The date, under date, January 2nd, the purchase account is to be debit, then to cash account, and the amount would be 20,000 in debit and 20,000 in the credit, and the narration would again be given for what this transaction has happened and recorded, being goods bought for cash. Now what is the third transaction? Third transaction is bought goods from Kamlesh for rupees 30,000. Again we have to identify the two accounts which are associated with it and then with which category they belong, and then we'll applying the rules of account. So in this transaction again we found the two accounts. One is related with the goods, and goods are bought on credit because it is being bought from an individual person and it is not mentioned in the transaction whether it is bought in cash. So always we would be treating this kind of transaction on the credit basis. Here one account is related with the goods and another is related with the Kamlesh, and that is related with the personal. So goods belong to the real category and Kamlesh belongs to the personal category. And we also know that the goods is bought, hence it is coming into the business, and Kamlesh is giving goods to the business. So applying the rules of both real and personal, we find debit what comes in and debit the receiver and credit the giver, right? So what we are receiving? We are receiving the goods, so it is to be debited. And who is giving the goods? Kamlesh is giving goods to the business, so he should be credited. So what would be the transaction and how we would record in the journal? We would be just writing the date, January 3rd, and then debiting the account. What is debited account? Is the purchase account debit to Kamlesh account. The amount would be debit and credit again with the same amount, 30,000, 30,000. And again we will be closing the entry by writing the narration, and the narration would be being goods bought from Kamlesh on credit. The next transaction was bought furniture for rupees 10,000. How we would journalize it? Here furniture is being bought, but it is not mentioned whether it is bought for cash or on credit. Since no name is mentioned there, hence we will consider it for cash. If the name would have been mentioned, then it would have been treated on the credit basis. This is to be followed in all cases, that if there no name is mentioned, then the transaction will be of cash nature, until unless it is specifically categorized that this is the transaction on the credit basis. Hence, in the above transaction, one account is furniture, another account is cash. Furniture being the asset, it belongs to the real group, and cash being again is belonging to the real category. Hence, both accounts we find that is belonging to the real category. Applying the rule of the real and the real account, we would be debiting and crediting. So what is coming is to be debited, what is going out is to be credited. So what is coming? The furniture is coming, which is to be debited, and what is going out of the business is the cash. So what would be the transaction? Furniture account debit to cash account, and the amount would be 10,000 and 10,000, and we will close the entry by writing the narration being purchase of furniture for cash. Transaction 5. If you see the transaction in the transaction 5, we or the business has sold goods to Mr. Shyamlal and Sons for rupees 25,000. Again, identifying the accounts, we can see at least one is visible, that is the Shyamlal. Shyamlal is the name or the name of individual, since then it belongs to the personal category, and it sold the goods. It means the goods are being sold. It means goods are related with the real category. So the two accounts are first identified, that is one is goods, another is Shyamlal. Goods is related with the real category and Shyamlal related with the personal category. So applying the rules of the real and the personal, we can easily record the transaction, or we can identify the transaction, that is the debit Shyamlal, since the Shyamlal is the receiver of goods, debit, and we have credit the sales because in case of real account, we have to credit what goes out. The goods is being going out from the business, hence it is to be credited. So the transaction would be Shyamlal and Sons account debit to sales account. Transaction 6, sold goods for cash rupees 15,000. So identifying the two accounts, one is goods, another is cash. Both accounts are related with the real group. Goods also related with the real, cash related with the real. So as per the rules of the real account, goods is going out and cash is incoming to the business. So what is incoming is to be debited and what is outgoing is to be credited. So cash is incoming and goods is outgoing. So the cash account debit to sales account. This would be the journal for this transaction. So since cash is incoming is to be debited, goods is outgoing, the sales is to be credited. So cash account debit to sales account. In transaction 7, it is goods worth rupees 2,000 withdrawn for personal use. The goods or cash withdrawal by the owner for his personal use is termed as a drawing. Hence, in the transaction, the two accounts are goods and the drawings. So, since the goods are withdrawn, the goods is one account, another being withdrawn by the owner. So, it is called the drawing. Investment by the owner is termed as in capital, and the withdrawal by owner for the personal use is termed as a drawing. So, two accounts are, one is good, another is drawings. Goods are related with the real group and drawings are related with the personal group since it belongs to the owner. So as per the rules of real, the goods is outgoing, and as per the rules of personal, the owner is the receiver. So the receiver is to be debited and outgoing goods is to be credited. The transaction in the journal would be like this: drawings account debit to the goods account. Transaction 8 says the salary paid for rupees 3,000. So we have to again identify the two accounts. So one is identified, that is salary, another is again not identified. So no name is given, so we will again treat it as the cash transaction. So the two accounts are salary and cash. Salary belongs to the nominal group, being an expenses of the revenue nature, and the cash with the real group. Applying the rule of the nominal, the salary being an expenses is to be debited, and applying the rule of the real of the cash is being outgoing, hence it is to be credited. Hence the journal for this transaction would be salary account debited to cash account. Transaction 9 is for the rent paid for January, that is 10,000. Again we have to identify the two accounts affected. One we can identify, that is rent, another no name is mentioned, so we'll deal this transaction as a cash transaction. Now two accounts are identified, one is the real, another is the cash. So applying the rule, the rent is related with the nominal account and cash related with the real group. So applying the rule, the rent being expenses is to be debited and cash being outgoing from the business is to be credited. Hence the transaction in the journal would be rent account debit to cash account. Transaction 10, the cash paid to Kamlesh. Again two accounts is to be identified. One is the cash, another is the Kamlesh. The cash related with the real group and Kamlesh being name is related with the personal group. Cash is outgoing and Kamlesh is receiving the cash. So the Kamlesh is receiving the cash, the Kamlesh is to be debited, and the cash being outgoing from the business is to be credited. Now the transaction in the journal would be Kamlesh account debit to cash account. And again you have to write the narration in all the transactions. For this transaction, the narration would be being cash paid to Kamlesh and the amount in the debit and the credit columns. So this way we have to record the transaction in the journal. Now let us summarize that what we have learned out of this module. So we have learned out of this module double entry system, and we have seen that according to double entry system, every transaction has twofold effect by affecting at least two accounts in opposite direction, positive and negative. Thus, if a business transaction result in increase in any asset or liability, then there must be a corresponding decrease in another asset, the liability, simultaneously. Finally, we have seen that how we record the transaction in the books of journal. Before we record the transaction in the books of journal, we have to apply the golden rules of accounting for the real, personal, and nominal category of accounts. Now let us recapitulate what we have learned out of this module. We have learned that double entry system, about the double entry system, and we have seen that double entry system was recognized world level when a book was written by the Luca Paslio, and it was published in year 1494. We have seen that according to the double entry system, every business transaction has twofold effect, and that affects in the opposite direction. It means one must be debit, another must be credit, and one must be positive, another must be a negative direction. We have seen that a business transaction results in increase in any asset, decrease in any liability, increase in any liability, or decrease in any asset simultaneously. We have learned that the business transactions are recorded in journal using the golden rules of accounting that is based on the double entry system.